Yes, and we will continue with another presentation coming from a digital currency project, and it's from Karina Johnson from the Eastern Caribbean Central Bank, and she will bring us her project, not hers only, but the digital currency project. The floor is yours.
Thank you very much. Good afternoon, everyone. Good afternoon to those joining online. Karina Johnson, thank you for your interest. 5 years ago, almost to this day, in March of 2021, another currency union, another multi-state currency union, launched its own retail central bank digital currency. That currency union was the Eastern Caribbean Currency Union, and that central bank was the Eastern Caribbean Central Bank. That retail CBDC was the digital version of the Eastern Caribbean dollar. And so today, I wanted to share with you our experience in operating our DCash, system for 3 years, as well as the insights and the lessons learned from that experience. And so in beginning, just a quick bit of insight into the ECCB. We are the monetary authority for the currency union. We are also the regulator for our banking system. We supervise the banking systems in 8 sovereign territories, together with a population of approximately 650,000, so relatively minor by most comparisons. Notwithstanding this, these are 8 separate, geographically separated, distinct economies, and with their own governments. In terms of what we set out to do with our DCash project, our main motivators, as with many first-generation CBDCs, was to modernize our payment system. Our payment system in the ECCU is dominated by cash, as well as proliferation of payments by check. We have been, over the last decade, seen a rise in the increased use of card payments. And so the introduction of a retail CBDC was meant to enhance this movement towards more efficiency in our system. We are also a region that has been defined by seasonal natural disasters. Hurricanes, particularly, leave many of our islands and economies both financially as well as socially at a standstill for weeks at a time annually. And so resilience in our payment system, and so for our islands as well, was another important motivator in doing this. A portion of our population, not insignificant, has also been excluded from our formal financial system, owing, in fact, to the onerous requirements for participating. And so financial inclusion was among the main drivers of what we did with DCash. And rounding that out was business competitiveness for our small businesses, particularly in the ECCU, providing them with a low-cost digital payment option. And so with that, we set about to not just conduct a pilot, but to run a live deployment, real money, real users in real time. We were guided by a number of key principles in doing so. Chief of which was sovereignty, ensuring that the central bank retained its role in the monetary system, and that it was the sole authority who would issue central bank money. The other one was that we should not introduce an instrument that would replace entirely cash, but that would support the natural movement of our economies to cash light status. And so beyond this, financial inclusion. In designing the system itself, we felt that this must be registered and that one of the options must allow for persons to be able to be onboarded even in the absence of a formal banking relationship. So those were among the key design principles that we engaged in planning for DCash with. So our timelines ran from 2019 when we began our research and work towards the pilot. We also, in 2019, engaged a technology service provider, and this research and planning for DCash continued. We launched, as I mentioned, in 2021, initially to 4 of our 8 territories. And in 2022, we completed that rollout with the remainder. And between 2022 to 2024, when we wound down the pilot, we had the pilot operating in all 8 territories, and that meant we had participation from our financial institutions as well as the ECCU public for those years. Sharing with you here a simplified diagram of the DCash system. We built a system that was built on distributed ledger technology. We use Hyperledger Fabric. This choice was for security as well as scalability. At the time, we felt that it was the best option in the market in addressing a number of the key concerns to us as a regional authority, and it provided an efficient way of addressing the double spend problem. Beyond this, we offered a number of proprietary wallets, proprietary in the sense that these were the only wallets that the system itself would have engaged, and these were of 2 distinct kinds, consumer wallets as well as merchant wallets. The consumer wallets, again, we retained the impetus for financial inclusion. So we had a specific class of wallet or value-based wallets, and this was distinct from our register-based wallets through which access to these wallets were controlled by our financial institutions, yes? Access to the value-based wallets, the wallets meant to encourage and support financial inclusion, this access was controlled by agents who would review the simplified due diligence requirements submitted by wallet holders before granting them access. In addition to this, we had a dedicated financial institution interface for participating financial institutions who would receive directly and exclusively CBDCs from the ECCB. The ECCB ourselves, we held a treasury wallet. Among the other features implemented at this stage was the conscious choice not to include transaction fees at any stage in the DCash system. This meant that for users, it was free of cost for financial institutions. However, it also meant that there was no incentive built into the system, no revenue model. And this was a deliberate choice for us in that we understood what we were doing to be building a digital public infrastructure, not necessarily just a commercial or for-profit product. Of course, there are trade-offs to that decision. It meant, as noted, that the incentives for participation for financial institutions would not necessarily be profit. The expectation in setting upon the pilot was that with time, the savings through less fees for cash custody, for the purchase of cash, for handling cash, would also in its own way incentivize participation from the financial institutions. Another reason for that particular decision is that, again, financial inclusion was intended to also ensure that it was accessible not just in terms of holding wallets, but actually utilizing the DCash system. So together with this, the other major choice was from the outset, we ensured through legislation that the digital version of the EC dollar was recognized as legal tender. It meant that the ECCB's governing legislation empowered the ECCB to also issue a digital version of our currency. And together, our main focus was one, to ensure that a system was built and deployed which retained the ECCB as the anchor of that system and allowed us to continue to maintain our role as a central bank. In doing this, and especially in doing this in the early stages of CBDCs, we encountered a number of tensions, and one of which I share here is the instance of our legal tender, which we have a mandate to issue, being built on private commercially operated infrastructure. And that's a reality in that open source infrastructure for CBDCs, at least back in 2021, 2020, was still much more limited, less developed. And so we have a situation or a tension where our currency, which we provide to our financial institutions for use by the public, is, or it depends on the continuation of a commercial relationship. Yes? And so you may say, but Karina, this is, a non-issue. There are protections in place that can, address these. And our answer to that from our own experience is that these mitigations, yes, they are there, but they are not fully resolving this particular tension. So some of these mitigations include audit rights, the right to audit the system periodically, contractual oversight of the infrastructure and the operator, as well as source code escrow and data portability. Inherent in each of these mitigations and collectively is having a partner that is cooperative and that is able to fulfill their side of the bargain. And I'm not necessarily saying that you may have, a bad intentioned cooperator, but there are many different cases in which the cooperation and the capacity to fulfill their side of these mitigations is compromised. And so this is why we, from our own experiences, understand these mitigations themselves to be something that, as we develop CBDCs beyond, they have to be relooked at so long as the infrastructure continues largely to be built on private commercially operated technology, as well as where it is concentrated in a limited number of vendors, or even, in our case, a single vendor. At this point, just sharing from the actual operation of our pilot, what were the major takeaways. Over the period in which DCash operated, we saw over 400 merchants onboarded. We had the voluntary participation of 21 financial institutions, including commercial banks, which we ourselves regulate, as well as credit unions, which are regulated by domestic authorities in each of our 8 countries. We saw just about 2.5 million DCash in circulation at the height of the pilot, and a ratio of 2-to-1 in terms of wallets uptake between value-based wallets as against register-based wallets, and a total of just over 4,000 transactions over the period of the pilot. And a number of signals can be extracted from these figures. One, the 2-to-1 ratio value-based wallets to registered-based wallets in many ways to us validated our financial inclusion hypothesis. That is where we took deliberate steps to lower the requirements for participation in our system, that those resulted in an appetite from the unbanked to participate. The other key takeaway is that the two-tiered architecture in which the ECCB was solely responsible for the issuance of currency, this continued to work. On the other side, and meaningfully as well, for us, we also noticed that merchant activity was concentrated in 2 of our 8 territories, and these would be 2 of the larger territories. A number of reasons surfaced for this, including the extent of development of the ecosystem, the support ecosystem for having persons onboarding and having merchants being able to access both funds in their wallet as well as to withdraw funds from their wallet to their bank accounts. This was also compounded by the fact that there was no integration of the DCash system with the core banking system. So it increased the number of manual interfaces or interventions in the system overall. The other signal that is of significance here is that after 3 years, 1% penetration, just over 6,500 persons out of our total population. Notwithstanding this, we would also speak to beyond the numbers, beyond actual transaction volume and adoption, that there are conversations around CBDCs that remain valid. Yes, when you are offering a retail CBDC, user uptake is important. However, our experience from the DCash pilot is that this is not the end of the discussion. And so from our experience, a number of key takeaways from the pilot. One, that it is feasible to have a legal tender digitally issued. This was a question that was largely unanswered in 2019 when we started. The second is that we built institutional capacity. So this was not through the result of a consultancy. This was not in theory, but we have 21 financial institutions as well as a central bank who has hands-on experience in offering central bank digital currency. And 3, as another major takeaway, a lot of the lessons from the pilot we have utilized in a wider, broader instance in catalyzing a number of reforms, including the utility of simplified due diligence. We have now codified that in ensuring that across all 8 territories, basic transaction bank accounts are available to persons through the provision of simple KYC information. So those were some of the major highlights outside of just pure adoption, which continues across all first-generation CBDCs to be its own challenge. Speaking of first-generation CBDCs, we see a number of similarities across the board, and I'll just mention 2 here briefly. These are things that would not necessarily have surfaced before you've gone into production and gone live. One is that, yes, with a real-time settlement and payment system, you have 24/7 availability. It is mismatched, however, by the support that most institutions are able to offer, which is confined to work hours. And this is a reality that, is not fully accounted for in planning. The other major one I'd mention from our own experience is the fragility of trust. You only understand that, again, the extent of it in running a CBDC. The burden of proof is never satisfied or discharged. Each interaction that a user has, a bank has, etc., with the system is a chance for you to prove, for you to build trust. However, any instance in which that trust is broken can be, in many cases, severely damaged. And we experienced that ourselves when our system went offline for a total of 2 months in 2022. while we did not have any defections by any financial institutions, the participation, the level of responsiveness of our financial institutions following the system returning, it was materially decreased. So I just wanted to highlight those as patterns across. I know my
Karina,
time is...
yes. It's not, if you want to highlight, maybe you can do it through an answer to
Sure.
a question. Do we have a question? Do we have a question? Yes, there's one question, yes.
My question is about this value-based wallet. So it seems it works well for the underbanked or unbanked, as far as I understand. But how can an unbanked individual access this value-based wallet, or so can they access through a bank, or should they do through digital onboarding? How it works in practice?
Great. So the value-based wallet, again, which was designed to improve financial inclusion, it meant that they did not have a pre-existing relationship with a bank. And so we had agents designated throughout each island, geographically dispersed, that would review applications. The applications themselves were entirely digital, meaning you were not required to come in at any single point in time. You would submit the 2 pieces of identity material required, identity information required. It would be reviewed. You would be approved and onboarded remotely. So the intent was to ensure that all barriers, whether it's physically having to leave, travel to get to a bank, whether it be the requirements for proof of employment, etc., that these were addressed systematically.
And I would allow a very quick question with a quick answer. Yes, I'm coming.
I just wanted to know what are further plans of Eastern Caribbean Central Bank regarding CBDC deployment. What are changes that would be made in next designs, if there will be one?
Okay, I appreciate that question. And so if we were to build a CBDC in 2026, a couple of the key takeaways would be: one, interoperability. The reality is that you cannot have a central bank digital currency as a closed garden in 2026, that there must be open standards, including the ability for interoperability with financial market infrastructure, as well as stablecoins, which are nascent but prevalent in the ECCU. The other thing that we would do differently is to build modular to avoid vendor lock-in, to ensure that in the event that we need to move, we can do so easily. Core infrastructure, modular, ensuring that the settlement layer is controlled and operated exclusively by us as a central bank. Those would be some of the key takeaways. In terms of our future plan, the reality of being a central bank of small economies, we have pivoted our focus to the implementation of our instant payment system. And this means that for now, further work on DCash 2.0 is paused while we devote our institutional resources to this important project.
Thank you very much, Karina,
Thank you so
from
much.
ECCB.